What's up guys, Raymond here with episode 4 in our financial statement analysis videos for the German industrial stocks. And in this video we're going to be analyzing the financial statements for a company called Bilfinger. Please correct me if I'm pronouncing this wrong. Yes, so as I said, it's episode 4 in our German industrial stocks financial statement analysis series. And without further ado, we're going to get straight into the key ratios. What we do in these financial statement analysis videos, if you're new to my channel and if you're new to my financial statement analysis series videos, is we analyze the top 3 financial statements relevant to a company, those being the income statement, the balance sheet, and the cash flow statement. And we pick out the key factors, or at least we focus on the key factors of each statement. For example, in the cash flow statement, we focus on the dividends paid, if the company is paying dividends, and we look for these different indicators from each financial statement just to kind of come up with an idea, an overall image of how well the company is doing financially in the past 3 financial years, 2019, 2020, and 2021. And we kind of want to predict to the best of our abilities how well the company will do in the near-term future as well as the long-term future. So without further ado, let's get into the key ratios. The market cap for this company is 1.21 billion euros, which is really good. We always like to see a company that has a market cap, which is short for market capitalization, which represents the overall price of the company, as comprised of the individual units of the company divided up. So the divided up shares of the company, which is available for purchase to the broad market, the public market, multiplied by the price of each unit. That is what the market cap is. We always like to see a market cap of at least 1 billion in its denominated currency. It shows that the stock has reached a certain level of attractiveness to the broader market. It usually represents a minimum amount of time that the company is stayed, or at least the minimum level of attractiveness that the company has reached in its time as a listed company. So the revenue figure is was 3.74 billion euros in the 2021 financial year, which is almost 3 times actually more than 3 times the market cap, which is the overall selling price. We're going to check we've actually seen that quite consistently in the past financial statements that we looked at, but we're also going to check the yearly performance as well as the max performance, so its lifetime performance as a stock, as well as its profit margin, its consistent profit margin. So we want to see if its profit margin is higher than its overall price, overall market cap. If that is the case, then we will have really good investment. But then of course we have to check out other indicators, but it wouldn't necessarily be a good sign, because if the market has valued the company at a lower rate or at a lower value than its overall sales, at 30% roughly of its overall sales in one financial period, that means the company isn't valued very highly to the broad market. But yeah, so the dividend yield is very high, 16.12, which is over 300% of the minimum percentage we require. Well, that I say is a good percentage of 5%. We'll obviously have to check the reason for that. It's usually because the stock price has decreased very rapidly, as well as to a large degree. The PE ratio, which we say a good level of which is 10, is 9.54, which just depicts the price of each share divided by the earnings per share. It kind of just depicts the expensiveness of the stock, and the earnings per share is 3.09 euros. So it's just the overall earnings for from the entire company that the entire company is made in 2020, in the last financial year, divided by the amount of shares outstanding. So the company is made about 3.09 euros for each share. So if you divide 3.09 euros by 29.7, that's about 10%. So that's about 10% earnings per share, which is really good. The beta level is 1.44, which is the beta is just the overall risk level in a ratio or in a decimal number, which is 1.44. It's 44% of the average. The average is 1. That is higher, about 50% higher than the average. But then again, we've seen quite high. We've seen above we've seen beta levels above 1 quite consistently in the past financial statements we've looked at, in the past companies we've analyzed. So it's quite common. But yeah, the income statement, which is the first of the financial statements, we're going to look at the graphs. As you can see, the company only made positive net profits in the 2020 and 2021 financial year, and it wasn't the profits weren't so large. It did manage to have a profit net income increase from 2020 to 2021, but only by a small degree. But the revenue figure is very high. It's around 4.33 billion in the 2029 financial year, and it decreased quite substantially in the 2020 financial year, but it also increased marginally in the 2021 financial year. So we're going to get into the balance sheet, which depicts the overall liabilities of the company. That include debt, short-term and long-term, and other liabilities. So liabilities are just what the company owes to different parties, and the assets, which is the light pink figure, is just what the company owns and controls, the assets. So as you can see, the company has managed to maintain just under a healthy level of 50% debt to asset ratio. I always say 50% debt to asset ratio is kind of a redundant figure. It's not specifically based on anything factual. It's just I believe that 50% debt compared to total assets is a maximum amount of debt that a company should have on its books. But yeah, the company's managed to maintain its debt to asset ratio over the past 3 financial years. It managed to decrease it to a healthier level in the 2021 financial year, which is the most recent financial year, to closer to a 50% figure, which is really good. The lower the amount of debt that the company has on its books, the better for shareholders, because net profit is more can be net profit isn't or at least a larger chunk of net profit isn't swallowed up by interest that needs to be paid on the liabilities. So let's get into the cash flow statement, which is the last of the financial statements that we're going to look at. We're going to look into more detail into the cash flow statement. The net income is the starting line, which was 115 million euros in 2021, and the cash flow from operating activities was also 115 million euros. The cash flow from investment activities was 283 million euros. So the company managed to, I guess, depreciate 61 million euros, or at least get rid of 61 million euros worth of capital expenditures. And 344 million euros was gained in other investing cash flows. Financing activities was 266 million euros negative, 76 million euros of which went to dividends paid out to shareholders, and 158 million euros of which went to eliminating debt, which is probably why we saw a decrease, quite a significant decrease in its total liabilities from the 2020 financial year to the 2021 financial year. Lastly, the net change in cash. We're going to skip the foreign exchange effects because it's quite minimal. It's just under 1 million euros, which isn't a large contributor to its overall cash flow. The net change in cash was 132.3 million euros. So it currently has 132 million euros of cash in its accounts. Let's just check how the net change in cash has changed, as well as the net income over the past 3 financial years. From 2019, the company had a net income of 6.2 million euros and a net change in cash of 46 million euros. The company in 2020 had a net income of 115 million euros and a net change in cash of 10 million euros. So it increased its net change in cash by 4 million euros. And in 2021, as we just saw, it increased it massively to 132 million euros, and it had a net income that was about the same as last year. So it hasn't managed to increase its net income very much, but it did manage to decrease its liabilities. So it was actually more productive if you think about it, because the company used less borrowed assets to generate the same amount of cash. And it also managed to save a lot of cash it managed to save a lot of cash because it has 132 million euros in cash in its accounts. But without further ado, I'm going to close this video. Thank you guys for watching. I will hopefully see you in the next episode, which is episode 5.